All right. Good afternoon, good evening, or good morning, depending on where you're joining us from, and welcome to another episode of the AI Circle brought to you by the iFlip YouTube channel. I am your host, of course, Aaron Yoon. Pleasure to be with you again after a 2 week hiatus. And of course, joining me is none other than iFlip Chief Investment Officer, Kelly Korshak. I had the screen share up by mistake. Kelly, welcome, Kelly.
Hello, Aaron. Hello, everybody.
All right, so we're just going to jump right in here. We have a lot to cover. We had the Fed announcement today, and also we have Kelly. Unfortunately, isn't feeling 100% today, so we are going to just jump right in to everyone's favorite introduction of everything: the disclosures, of course. So bear with me with this disclaimer. iFlip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip portfolios that you select are suitable for your investment profile before trading on a live brokerage account. So we'll get that out of the way here. And all right, bring Kelly back on the screen. Kelly, I'm gonna. The floor is yours. We had announcements today. Please catch us, and we also had a 2 week break since our previous AI circle. So please catch us up on what the announcement was today, how the market interpreted it, and what happened over the past 2 weeks.
Okay. Hello, everybody. Yes, I don't catch everybody up. Pardon me. I have an allergy that has got me. It's kicking my nose's butt, if that's possible. I think let's just go over what the happened today at the Fed. I think it was actually kind of the usual ho-hum with a little volatility sprinkled in. The Fed, of course, as expected, going into this, paused raising interest rates, but simultaneously the Chairman Powell, in his press conference and even in his statement, mentioned that they're very likely to raise rates further later in the year as inflation remains hot. So today, of course, as a result of that, the markets, the Dow was always under pressure because of United Healthcare. However, the rest of the Dow was kind of holding up. After the announcement, the market did the usual thing, tried to rally a tiny bit, and then it fell off, and then, of course, recovered. So today, the Dow Jones was down 230 points or so, but guess what? The S&P was up 3 points, and the NASDAQ was up, believe it or not, another 0.7%. There is no stopping the NASDAQ. And as long as this is true, and those 7 stocks that we've all heard about are holding up the market will have a buoyancy to it. The long run effect, in my opinion, of what the Fed announced today is that they own the fact that inflation is harder than they thought to come down, to put under control. But this is always the case. And so there's nothing really new to be learned there. However, what is to be understood is that if they do raise rates later in the year, those things generally mean they spell trouble for technology. And after all, it is technology that's holding up this market. So let me start off to have a continuation of where I've been all year and where I was 2 weeks ago, and point out that generally, like many other pundits that have been struggling to understand this market, I, like many others, have held a cautious hand in 2023. In my, again, opinion, is that the market is really something that hasn't got the memo. And the memo is that there are enough things in this world that make it very difficult to own stocks. You're now starting to hear the the mantra of this is the most hated bull market or the second most hated bull market ever. And it's now called a bull market because of one thing. The S&P came out of its 20% correction territory and now is only down 10% from its all-time high, pardon me, that was achieved on December 31st of 2021. And that feels almost like a miracle. Let's take a quick look at the S&P 500. And so back in October, this is when the rally started. And the rally from down here to where we are now is approximately 20%. And if we look back at the all-time highs back here, which is, of course, December 31st of 2021, you'll see it was at 4,800. We're now at about 40, just call it 44, a little under 4,400. So we're 10% off the all-time high. And this rally has, of course, defied both expectations and gravity. The few people that were brave enough to be long have kept track with the markets if they've been in the S&P, because guess what? The S&P 500 is still being buoyant as a result of those 7 stocks. Let's take a look at the Dow for reference. As you can see today, the Dow has really gone nowhere. The Dow also is off approximately 10% from its high. However, this year, it's really gone nowhere. It is up a marginal amount of for the year. By the way, back here just a week ago, the Dow Jones was teasing with its 200-day moving average, which, by the way, puts it essentially, if you look at where the market came into the year, would be down on the year. So just a week and a half ago, the Dow Jones was down on the year. And this is also true of the Russell. Just literally, if we look at the market, literally a week ago, here's where the market started this year. A week ago, the Russell was down on the year. And it has rallied just marginally, maybe 100 points off of that. So it's up about 3.5%. So the last 3.5%, 4% rally in these two, the markets, the Dow and the Russell, have essentially taken it from negative on the year to up that small percentage on the year. Let's look, of course, at what's really driving this. And there is the NASDAQ. Look at it go. It is now sitting actually 3 standard deviations above a long-term moving average. Traditionally, this would be a mean reversion trade. So people would be putting on a trade right now where you are short NASDAQ perhaps and maybe long the Dow Jones. I don't like the trade, but that would be the mean revert trade. Short the NASDAQ, maybe long the Dow, long the S&P 500. But again, I don't like the trade, and here's why. Let's look at the 7 stocks. So how could these 7 stocks make all these indices go up? We'll go a little quick deeper dive. But in effect, those 7 stocks represent now almost 28% of the S&P 500. 7 stocks. There's 500, so 493. If these 7 stocks were just up only 10% on the year, the S&P would be down on the year. However, these stocks are up closer to 30% on the year. I mean, I don't need to tell you, Apple is right at almost all-time highs. Amazon, trying to recover. It's down, but it has still had a very good rally in 2023. So it's up from the mid-80s to 126. So we can say that that's a 30% rally. Google, this is even a larger. It's a 80 to 127, about the same actually as Amazon. Meta, even more, from 100 to 273. So Meta itself is up 173%. And Microsoft, of course, look at this, almost all-time highs, and it is up from 220 to 330. So that's up about 50%. Now you can see, let's look at Netflix. We know this one here. has been up for the year. It's still up approximately 275 to 440, another 35%. And then let's go to NVIDIA, screaming. And of course, now that is up from the beginning of the year about 300%. So these are markets that are very difficult to take advantage of because of the nature of the way they exploded higher. We are long some of them in some portfolios. However, we are not long the S&P. Now, let's take a look at that. The S&P has been out of the market this year on our behalf, mostly because, and entirely because, we have a machine learning signal that has kept us out of the market. During that period, we've had a couple of other signals on the underlying algorithm, but they were overridden by the AI because the AI is deemed more important. That being said, the AI is almost running thin. New data with the pause in interest rates may have an effect to change this, but my guess is it won't. Furthermore, if we take a look again at the main data that we look at, again, credit card defaults, car repossessions, M2 money supplies, I can tell you right now, those numbers are just expanding. Credit card debt is running at historic levels, and more people are starting to fall behind on both their car payments and their mortgages. So this is a very weird bifurcated picture. We have people falling behind on their mortgages and using credit cards to kind of hold them through these times. Yet at the same time, we have a job shortage where apparently people can't go back to work and find jobs, and that is creating a very tight labor market that's also keeping inflation high. And those being said, that in this environment, that means corporate profits, when they're looking for new customers and new employees, corporate profits now, of course, are going to be very close to their peak levels. What can disrupt this? Obviously, further interest rate hikes, which right now the market doesn't believe will occur. I think the market personally is priced in the fact that interest rates have come down for the first 6 months of the year. I've noticed almost on these anniversary dates that the market seems to respond, literally December 31st being a high in 2021. A low was being printed again at the end of 6 months in 2022. And of course, since 2023, the market for the most part has just ground further and then gained momentum as a result again of those 7 main stocks. So we remain, and I personally remain, sadly stubborn to my view that the market is over purchased and that a correction will occur. However, there is a time when that you must surrender the ideas. I just want the AI to do that. AI has always done better than me. And so, of course, I should probably go buy it for everybody's sake so we can put in a high, because I tend to do that very well. But that being said, I do expect some changes to occur somewhere around the turn of this month, the end of the second quarter. So let's go to a couple other things that I think look very interesting in this current environment, regardless of what the market does. Some of these bank stocks are definitely starting to show some recovery. I'm going to look right here at Bank of America. We do have a little double bottom showing up here. I kind of like banks in this area. They are definitely have the chance to revert to the mean. This is the weakest one of them. Let's take another bank like Goldman Sachs. Similar, we put in a low after the banking information came out in March, tried to rally, came down, but now we're kind of where we were before and the market appears strong. It does seem like Goldman has the chance probably to go move higher to 360, but not a quick bet on it. JP Morgan, prices are basically near their highs. So obviously JP Morgan doesn't care or think there's a bank issue, at least investors in it don't. Finally, let's look at Charles Schwab. Let's look at Chuck. I kind of am starting to like this formation. This again was partly their the banking crisis again with Charles Schwab. Remember, they are a bank and they're a very large company with a very large bank. And it has moved from basically about $80 a share down to now $54 a share. I feel there's a good probability that if I were to choose any of these banks, and given what I see in the markets, that this could be an opportunity for some people, and I'm trying to incorporate it into some of the smart folios, probably the moderate and or the conservative, because it does pay some dividend, and I think it has price appreciation similar to some oil companies. So I think that's of note. We should look at that. Another thing that's actually blown up recently is look at the cruise lines. This is Norwegian Cruise. All of a sudden, it seems to be back in play. And what I also noticed is that that's just one cruise line. Let's take a look at some of the more damaged ones like CTO, Carnival Cruise Lines. And guess what? It's doing the same thing. It has literally moved up from just a couple of weeks ago from under $10 a share to 15. And of course, I don't need to say that that is a 50% increase. And it's now sitting probably around 4 standard deviations above a longer term mean, which also tells me generally that would be something I would look to take some profits and see it go higher. However, in this case, the cruise lines look like a money magnet, and they are attracting investors because investors know that if we're at full employment, even with a high participation rate, people will spend money for cruises. So these are things that look interesting and also are incorporated into some portfolios like the SPY-I. However, just keep in mind that these are just things that we watch and try to keep into some of our portfolios because they are advancing. I definitely like to look for value if possible. So that goes to that. Let's take another look at some dividend stocks. So the oils, of course, has that been the market's moving higher? Has that caused oil to back off? Let's take a look at that. So here's ExxonMobil. So the rest of the country seems to be doing well in the markets. However, these things haven't moved much since 2023. However, they're paying 8% dividend. We're coming into the second part of the year, which means these things have already paid out 4% and gone nowhere. Great plays. That's why I definitely like red oil. And if we go back historically, you'll see the main reason to like these is if you go to some of these, the pipeline stocks that we've been looking at. Let's take a look at this. These are the same things, up huge amounts of numbers in just grinding higher. This looks like a market that has got some kind of fundamental supply, and that's fundamental supply is Joe Biden and the Democratic Party that, of course, doesn't like oil. They're green, so pipelines are not part of their future. However, I do think they're still part of the country's future, and I remain extremely bullish on these. And I like owning them because, again, they're paying just like Exxon. Exxon's less now, about 8% in their dividend, and they're up decently on the year, another, say, 10%. So I like the ownership of these. And let's look at the potential. This is the COVID back here, everybody. If you can see it, pretty big drop. There's a chance that this stock, which is at 13, can go to 24 and pay you a dividend. And this is one of the reasons we like this, and it is in the red oil portfolio, along with a couple others that look exactly the same. And here's one of them, Energy Transfer. If we go to that, it looks very similar. Even though we're at COVID, we're closer to the highs. Prior to that, I feel that this is a stock that has the ability to go to $17 to $18 a share from 12. That's a 50% increase, and also paying you, guess what? 8% dividend. Nothing wrong with that. Oh, it's always good to be rewarded and have upside simultaneously. We're going to jump real quick so I can get some questions in from Aaron and a few others, but I'm going to quickly go to the dollar, and let's take a look at that. Let's look at the dollar index. And I think, as we know, last year when we were talking about that, the dollar, of course, hit all kinds of new all-time highs on global currencies around the world. And last year, there was no stopping it. This year, we're even seeing commercials that, the dollar is going down. The dollar is in trouble. I may not disagree with that. And of course, the terms that the dollar is in trouble and that the dollar is going down. However, if we were to look at these things in historical perspective, if you go back as far, and I can tell you that if you go back as far as you wish, the dollar is still very close to all-time highs, even though it came off the highs in last October and the market has rallied. The dollar, if it is dead, and there could be a lot of reasons why it should be, it's still, don't think that it is going down and it's becoming worthless. It is still the strongest currency in the world. Now, yes, there are backdrop problems all over the place, but you can never, just like America, you can't really rule out the dollar. And so let's see where the dollar goes, I think, in this new range here for the dollar index of 101 to 105. It's sitting basically in the middle. If it does get above 105, we're probably going to go higher in the dollar. And that would tell me the stock market is going to go weaker. But however, if the dollar becomes weaker, there is a strong probability that the stock market could go higher. And that is the relationship we have now. And so that's a very important thing to note as we look at one final thing before we go to Aaron. And that is, let's look at crypto here. Here's Bitcoin. So we did hit our 30,000 objective like we thought right back here. This was something, at least I correctly predicted this. However, it is now falling. And today, of course, it made another low. And as a result, there will be some support in the area coming soon. We're now down to 25,000. My thinking is the market can go to about 23,000 and some change. And I would be a buyer of cryptocurrencies at 23,500 on Bitcoin. And that would be around, on the Global Bitcoin Trust, I would be a buyer of around 1190 a share. So those are things I'll keep you posted on going forward. And that's an update of the markets as they are right here on the middle of June of 2023. Aaron.
Thanks for that, Kelly. Appreciate it. There was so much stuff. So very comprehensive overview. And I do have a couple of questions for you, and we do have a couple of submitted questions. But before that, just a little bit of housekeeping for everybody watching at home. We are going to start doing a little bit more of an interactive dialogue in the AI circle. We've gotten used to this format. We want to engage with you even more than we are already doing. So similar to the mailbag, we're going to invite everyone to chat in the chat box in the comments section. Sound off. Submit your questions. Email mailbag at iflipinvest.com for any user submitted questions that you want Kelly to answer, and we promise we will get to them all. So we are going to have it be more conversational. So looking forward to engaging with all of you. So for everyone at home, that is usually like used to just watching or listening to this passively like a podcast, we invite you to engage with us. And trivia questions coming up soon. So you want to get your thumbs ready or your fingers ready on the keyboard in just about 5 minutes here. Before we get to that, though, Kelly, I have a couple of questions for you. You said something very, very interesting. And that is that this is the second most hated bull market ever. Now, why is it a hated bull market? Isn't stocks going up a good thing? And if this is the second, then what's the first? I almost feel like that's a trivia question, but I'm just gonna put it out there for you.
First one was the bull market that occurred after the 2008 debacle and in the 2009 lows. When the market started to go up after seeing such carnage on the way down, it was a 54% decline. The Janus 20 index fund, which was the largest in the world at the time, closed its doors. So after 2008, in 2009, when the market started to rally, people couldn't believe it, but yet it climbed a wall of worry, literally to the point where we did recover everything. However, it did take 5 years to recover, but nobody wanted to believe in the market for the first year after the 2008 financial crisis. So that's the first most hated one, if for the direct answer. I don't believe in the same similarities. I just know that hedge funds, including people like myself, I have to put myself in this category, have been a believer that something is amiss. This is kind of the reason why we've been focused on the conservative portfolio this year, because at least in the conservative portfolio, we are taking advantage of dividends. And this is one of those cases where I think I mentioned this before. I like it that if I'm wrong, or if we're all wrong and we're thinking too bearishly, you still can make money if the market goes up and actually outperform it. But however, if we stick to our guns for too long, we all run into something called FOMO, the fear that we are missing out on something. And that's something we always have to guard against. You're starting to see some of the FOMO here as the market kind of has rallied right into the Fed numbers. And the Fed numbers definitely knocked it off a little bit today, but it's still recovered for the most part. And two of the indices, again, were just up marginally on the day. There's another question out there, Aaron. I'll get to it unless you were going to ask me. It's about the AI, right, and the trend of the AI. And of course, exactly, that is why I pointed out those 7 stocks. I think everybody knows that those stocks I looked at were Microsoft and Apple and Nvidia and Amazon and Netflix, etc. The ones in Google, of course. We all know that these technology companies today are the ones that will bring AI to us. And so the issue I have with this, because of this buzzword, and by the way, we are in this faction where we do use artificial intelligence to help generate decisions to guide the actual trading and investment of your monies. The word itself is literally associated with those large companies, and they are driving them. Everybody now and wants all things AI, including us as a flip company. These things have become exciting to people. And if we don't own AI, then we are probably missing out on something. However, I have to, and I can't help but think that when I went back to the early 2000s, when I was definitely deeply involved in the markets, the same thing was technology itself. Technology was going to dominate the 21st century. And I have no doubt of that, but that's also the same time that the NASDAQ rallied 70%. Right now, those 7 stocks, if I had to collectively add up the ones I showed you, in total, not on a cap weighted basis, but on an equally weighted basis, they're up over 100%.
Right. Triple digits.
Triple digits. Mm-hmm. And anything that goes up like that comes down like that. And that was certainly the case in 2000 when technology seemed like there was nothing technology couldn't solve. And then less than a year later, well, we all know what happened. The NASDAQ lost 70%. Am I saying that's going to happen now? No. However, anything that is regarded so highly will have an Achilles heel. And when the heel is tested, we normally find that it's weak. And if it's weak, if those stocks for any reason came down, so for example, Congress limiting the way we are allowed to use AI and or apply AI and or build out AI, that would definitely create a problem for the market and those investors that have ran those companies up so much over the last 6 months that that would, of course, I think everybody could agree, be a big problem for the stock market and the S&P 500.
Yeah.
And it would surprise pretty much everyone. No one expects that to happen. And that means, and I agree, the probability is lower, but that was the same way people felt that the technology bubble in 2000 was very unlikely to ever burst. And then when it burst, well, we all know what happened. It was a sharp sell-off, and the NASDAQ took more than 10 years to recover from that.
Right.
So again, we're in these kind of uncharted territories. I do believe there's some level of caution, but there is no doubt AI this year is the word for the masses, and it has created the momentum in those stocks, and those stocks, their market caps have become enormous. It wasn't, by the way, remember, one last point on this before we get to the trivia question. It wasn't that long ago that I remember that Apple hitting $1 trillion market valuation.
Mm-hmm.
Now it's at $3 trillion.
Yeah.
What is that? That tells you something, and that some of these companies around the world are larger than states. They actually represent a political force. And so there is some kind of a change afoot. And what that means to society is not my business, but what does that mean to the markets? My instinct is it's going to add greater volatility to the markets. And by the way, volatility doesn't mean the markets go down. It just means that the markets are volatile. They can go up and down very quickly. And so my instinct is, in this case, that if we allow these large companies to get even larger, it does create some systematic problems for the world, but it does alleviate a lot of other things. And I think the net of it all would be generally positive over time.
Gotcha. Yeah, I mean, you're equating what we're seeing now with an AI bubble, if we're gonna call it that, with the .com bubble from 20 some odd years ago. And I didn't know the first thing about the market back then. I was in school still. I didn't know anything about the stock market, but I remember that. I remember hearing that on the news and it being a big deal and everyone panicking. And it seems like we're kind of in that that moment of like maximum hype right before the bubble bursts, similar to 2007, similar to 2000. And yeah, okay.
We don't know if this is going to create. Look, when bubbles come, if this is a bubble, they last a long time. And remember, no matter how much you think the market can go up, the market can always surprise you. And the main thing I think investors have to understand is you don't chase a market.
Right.
Ever. If you miss something now, you can always revisit it. I've learned in my life that even if people were to, and I'm not saying we do this or because we just work with math, but I can tell you that over time, when you follow rules and decisions made that are done so in a calculated way, you're more than likely going to have a better experience than doing something where you have some fear of either missing out on a rally or some fear that if you don't buy something now that has gone down so much, it's going to rally right back up and you'll miss that as well.
Yeah.
Right now, since the market's gone up and it's gone up with only 7 stocks, I think your choice is if you buy the market now, the stock market now, the S&P, it's almost like saying I'm willing to pay, for Netflix that has gone up 270% or 170% in 1 year. No, that's a chase. And if you buy the S&P, you're also buying that because it has such a huge representation in the S&P. my recommendation is you wait. You'd be surprised what happens, and all it takes is just a few months, and you can see that the market could look completely different. In which case, these things all bear out.
Yeah, the key word of the day is patience. Patience, patience, patience. Don't give in to the FOMO. All right. So thank you for joining us. We went about 5 minutes over, but I think it was a
All
very
right.
interesting conversation. And so thank you for everybody that was bearing with us, sticking around for the trivia question of the day. Now, you got to be quick to this because this is something that you can find relatively easily. So, trivia question time. The trivia question for tonight is, who was the Fed chairman during the 1987 crash? Okay, if I had the Jeopardy music, then I would play that right here, but I don't. So I will do this though. I can put a timer, and I will put a 30-second timer up on the screen, and to get the answers in. First one to put the correct answer on the screen here in the chat wins the recording of the Bulletproof Investing seminar. And in addition to that, starting next AI Circle, I didn't mention this before during the housekeeping, so it slipped my mind. But great news! Starting from next week. Next week we actually have the mailbag. So starting from mailbag next week, we are going to add another prize to the raffle to the raffle winnings. In addition to raffling off the recordings for Bulletproof Investing, we are also going to give away some Amazon gift cards, which I don't know about you, but that might as well be cash to me, right? And so we are still working out the denominations and the amounts and everything, but it's pretty much a cash prize at the end of these iFlip shows. So you definitely want to hit that subscribe button. Make sure the notification bell is on, and you don't want to miss a single episode because you could literally be making money for showing up here. All right. So I feel like that was enough time.
Amazon gift cards are good.
Amazon gift cards are good. And if you're not an Amazon shopper for whatever reason, I bet you know a ton of people who are willing to trade it for like actual paper cash if you wanted. All right, so we have a bunch of answers in. We have kind of a coin flip between, most people are saying Alan Greenspan. Our first answer though is Bernanke. Now, is that the right answer, Kelly?
No, it's not the right answer.
Okay, the answer is. Please enlighten us. Please tell
The
us.
answer, of course, it looks like based on what I saw, the answer, of course, is Alan Greenspan for the 1987 crash.
Yes.
And I'll let you figure out the winner. The first person I saw was the Lugaries.
Yes.
And so we can probably award that to them. And I want to remind people about one thing on this one. Alan Greenspan became the Fed chairman in the very same year of the 1987 crash. So he was literally baptized with fire. And with Bernanke, who someone else answered, came in 2006. Literally 2007 turned out to be the high of the market. And he ended up becoming the Fed chairman. Within a year, he was also getting his baptism of fire. It tells us that if whoever the next chairman is after Powell, look for some kind of market correction because all new chairmen seem to get one quickly.
Yep. It's like the market. It's like the Fed's hazing routine. It seems like
Almost.
All right. Well, that does it for today. Joe and Becky Ligori, you are our winners for today. And how do you qualify for the prize? It's not enough that you just answered the correct answer the first. You also have to be, in order to qualify and collect your prize, you also have to be invested in at least one smartfolio. So you need to send us an email with a screenshot of your account or your account number, whichever you prefer, and show us which smartfolio are you invested. Just send that over to mailbag@iflipinvest.com, and we will send over the instructions for you to access the Bulletproof Investing replay right away. Okay, that does it for this episode of the AI Circle. Thank you so much for joining us. Again, make sure If you like this content, make sure you hit that subscribe button and that notification bell so you can tune in live and have a chance to win prizes of your own for each one of the live shows that we do 3 times a month here on the iFlip YouTube channel. Okay, and that's it for tonight. Good night, everybody. We'll see you next week.
Take care. Bye, everyone.